Hi there, my name is Daniel Heidel, owner and investment advisor at Integritas Wealth Strategies. Today I just wanted to give you a little insight into something that we hear a lot in the industry called a contrarian. Some of the most famous contrarians out there might be Warren Buffett. You've certainly heard of him if you're in the investing world. He's a brilliant investor, very famous for finding inefficiencies in markets and making big gains out of it. Another might be Michael Burry. He was very infamous for shorting the housing market back in 2008 and noticing that there was a bubble. But a contrarian isn't exactly somebody who's looking for those big plays all the time. A contrarian tends to be more of a mindset towards investing and looking at the markets in different ways. So what this means, in essence, is a contrarian is somebody who looks at sentiment and overall feeling in the market, and they will basically go against it. So one of the most simplest ways that this plays out is where you see investors that are pouring into one sector of the market, and you know that one day this is going to flip. So a lot of things in the investing world tend to work inversely. So one of the ways that this can be played out, and I learned this sitting in my investment classes at Liberty University. In our financial planning program, we had a great professor that spent years with Merrill Lynch and Morgan Stanley, and he turned and pivoted and decided to teach young people how to do the same thing. And he would always explain to us that when people are very bullish, typically you can expect to be bearish. And when people are very bearish, that can be a bullish case as well. So the way that this plays out essentially is that, if people are very bullish and they're buying into the market very quickly, that's going to raise the price of any area in investing in any market substantially. And essentially what that means is that, we can look at the S&P 500 index. So people have been very, very bullish on that in large US company stocks. You can think of Tesla, you can think of Netflix, you can think of Nvidia, and all of those names. And when people buy in very quickly and in large amounts, and they really are excited about this and very bullish on it, expecting it to rise and increase in value very quickly, you reach an inflection point where the price is going to drop. And it's a matter of time. It's either going to go flat or it's going to drop a little bit. And it's very rare that you see something just on a steady incline for several decades. It's very rare. So basically what this means is that if you see a lot of bullish sentiment in the market, typically what happens is that it can be taken as a sign of over sentiment, over bought into any sector, and a time is coming where this is going to change. Something might happen economically, causing the value to decrease, or investors might decide that they're going to capitalize on their gains and sell out. And when they sell and they leave that market or that position or something like that, it's going to lower the price, and it's going to lower the price for everybody. So let's say you buy in high and people sell, or something causes it to stay flat or go lower, you are left essentially holding the bag if you stay invested in that position. Essentially is what I mean. So the problem here is you want to look and see how often are contrarians right. And contrarians, they do make big money at the right time. However, they can sometimes miss out as well. So this is why it doesn't pay to be an individual investor looking for the hot buy or the undervalued item. And you might look at what's happening in the world that you think would cause a price increase. And some of those things just don't materialize for many different reasons. Popularly, this was one of the things where in COVID, people expected Zoom and Teledoc and a lot of those other things to rise in price very quickly. So I knew some people that bought in. and some of them left with substantial losses. And it wasn't due to any one thing, but instead just a matter of different things. So when people are very bullish on those positions and they decrease, that is something where a contrarian would look at it and they say, I'm not going to buy into that. I'm going to buy into something else. So very famously, one of the things that Warren Buffett did was in the early and late 90s, when tech was really taking off, he said, I'm not going to buy into tech because I see a lot of people doing that. And he's a very famous contrarian, as we talked about. So instead, what he did is he bought into other sectors that were undervalued. He looked at energies, he looked at industrials, he looked all across the market and he looked for value. He was searching for that constantly. And that served him very well because, as we know and history tells us, there was a big tech crash. And this happened. So, and similarly, just the same, Michael Burry in 2008, many people were very bullish on the housing market. They thought it couldn't go down. They thought, the housing market's stable. The U.S. economy is stable. We're not going to see these things. And instead, what he did was he shorted the housing market. Now, this is by no means a suggestion that you need to avoid any one sector. It's not saying that you need to go and short the S&P 500 index fund or short a position or something like that just because it's rising in value, because that's not a good idea. I would not suggest options trading under many scenarios. I don't think that it often plays out well for the average investor. It takes a lot of intelligence and a lot of awareness, and I think you're then chasing a momentum, you're chasing a swing, and it's dangerous. And it's incredibly volatile, and you can lose a lot of money doing it. So I would not advise it. I don't think it's a good idea. However, what this does mean is that you want to be diligent and aware. So one of the things that, like, Warren Buffett, for example, is very famous on advocating for is being a very cautious, diligent, conservative investor. And what this means is that when, example, he sees things like tech names such as NVIDIA rising rapidly and people buying in and PE ratios are very high, he's not going to then go and buy the same thing. He knows that area, that market, that sector of the economy is already essentially very saturated with investors and the price is rising very rapidly. And he's aware of these things. So instead, what he does is he looks for areas of the market that are undervalued relative to their balance sheet, their financials, the way that the company is being led, the area that it's exposed to, and he might search to buy those. And these might be boring names. Some of the things that he's very famous for saying is that he doesn't buy anything that he doesn't understand. And I believe that he is also very interested in buying like bubblegum companies or things that he just thinks the U.S. consumer will always need. Now, this is by no means a suggestion that you need to basically go and just do whatever Warren Buffett does. Investing is very unique to each person, and there's different risks in all of this, and he is a large investor, and he's got very specific investment thesis. And every investor has his own thesis, and you need to basically figure out where your thesis lies and stick to it. So what being a contrarian is an advocate for is things like, dollar cost averaging, setting aside X amount dollars of your paycheck every pay period, getting into the market in a diversified way, not buying one sector, one industry, especially not one that is in the buzz. It's a buzzword in the market. It's NVIDIA, it's Tesla, everybody's buying it. You always hear it in the news. And that doesn't mean you shouldn't own those companies, but you just should not own them to the same level that some of the people suggest that you might own them. So basically what this means in essence is you need to basically look for places where you can obtain a large market share of many different sectors, be properly diversified across all asset classes in an appropriate manner. Percentages are very important. You want to look at overweights and underweights. And additionally, you want to have a very methodical approach. So I talked about this before. Look for the Moneyball thesis to investing. Get on base, hit singles and doubles, get the runs that way. Don't look for the big trades that are out there. And that essentially it's a very practical way to be a contrarian investor. And there's many different ways that you can apply this all throughout markets. So one of the ways that you can really take advantage of this is you can do a lot of research yourself. You certainly can. There's a lot of free resources out there. I'm not going to say that there's not, but it means you're going to need to devote a significant time to this, and you need to stay well read on what's going on in the world and the markets. Other options are you can search for an advisor. There's advisors out there that have lower costs and they might be more reactive and less proactive. There's others that are great advisors and they seek to educate clients much in the same way that I'm trying to educate you today. And I think that there's a lot of value there. There's people that charge high fees, so you need to be well aware of that. Ask for expense ratios, ask for the way that you're going to work together, how often you're going to talk, what things you're going to discuss, because there's much more to this than just investing. You need to find a diligent financial planner, somebody who has taken the CFP exam. I also like to look for CKAs, that's Certified Kingdom Advisor, because you know that they have an underlying integrity that's really forcing them inside of their inner feelings to serve you well, and they don't want to just profit off of you for any number of reasons. They're actually looking to help. They're looking to educate. So these are some of the things that you really want to look for and be aware of. So if you have liked any of this and you want to learn more, you can look down in the description for 5 useful tips for automating your investments and starting to build wealth. And that's going to be a very valuable guide to you. There's many tips in there, and additionally, you'll receive access to any other educational material that I put out. There's a lot forthcoming, and additionally, you can subscribe to this YouTube channel, and you can follow along. You can be updated on any other videos that I put out in the future, and you'll know what's going on. You'll start to gain a very good foundation of education for investing markets, financial planning, and many other things. So if this has been interesting to you and it's been educational, I'm glad to hear it. Like and follow along as much as possible. And yeah, if you're ready to go and you want to talk now, I'm available for a quick 30-minute call. We'll just jump on the call, talk about your problems, how I could propose possible solutions to some of those problems. And if you're interested, we can move forward with that. But yeah, if nothing else, please educate yourself. Look for resources. Look to gain knowledge in this space. People in this world will be left behind if they're not staying up on trends, and if they're not investing, if they're not trying to build wealth and make sure that their family is provided for and that they can provide for themselves to a meaningful level. So that's what this is all about. So yeah, if you like this, please follow along, and I look forward to talking to you soon.